thing. So yeah, so one or two couldn't make it, but felt this was going to be an interesting session, so wanted to take part. So Cliff is, as I explained in my invitation, is an entrepreneur who's actually bought and sold a couple of businesses, or maybe more than a couple of businesses, but has also written a book called The Cash Flow Code. But to my mind, a much more interesting book, the 10 or 12 things that you need to do to prepare your business for sale. And so that's what Cliff is going to be talking to us about today. But he's also been working with our software team to develop a whole load of diagnostic reports that are going to be very useful in providing due diligence. And I know there's a couple on this call who've seen a dummy copy of the report. And what we're looking to do is to try and take away, because there's an awful lot of sharks in this industry who charge phenomenal fees for preparing due diligence reports and prospectuses out there. So we've been working on how can we use the software that we've been helping develop to do a lot of the work for us. So with that, Cliff, over to you. Take it from here.
Thank you, Mike. Let me quickly share my screen. Right, can you all see my screen now?
Yes.
Yeah.
Excellent.
So can everybody mute themselves, because I've got to mute you. So if you can mute yourselves, and then if you need to butt in and ask a question, that way we won't interrupt.
Brilliant. Thanks, everyone, and good afternoon. Today, we are going to look at how to prepare your business for sale and planning your exit strategy, including going through the due diligence report that we have just created. Now, if any questions, please feel free to ask. As I'm sharing my screen, I won't be able to see everyone, so please feel free to interrupt me as we go along. But there's a lot to cover, and I hope to finish within the hour. And we are going to discuss the reality of being in business and why it's so important to have an exit strategy. We're then going to look at what that means for the business owner, especially in the next 5 to 15 years. But there are problems when it comes to acquisitions, and I will share with you some of the reasons why most deals tend to collapse, and which then is causing the market to stagnate. And I'll show you the solution and how you can also beat the odds. And then we will look at the exit value acceleration report, which is the new report Mike was referring to. Now, the reality is that every owner, irrespective of who they are, must exit the business at some point. Some people may wake up one morning and realize that, no, I've had enough. I don't want the hassle. I don't want the phone calls. I don't want the problems. I just want out. Some owners may be diagnosed with a health problem, causing them to either leave the business immediately or in the very near future. Others may have a change in personal circumstances, and that could be through ill health or death in the family, forcing them to either leave their business or have their attention redirected away from their business. And if the first 3 events are never encountered, there is one event that no one will escape from, and that's death. And if the business is not prepared for that, it will leave a whole host of problems, not only for the family, but also for the employees. Now, I've known owners who've encountered one of the first 3 events, and if the business is not ready for sale, it causes the value to plummet. Not only that, if the owner is needing to exit very quickly, this may lead to an unsuccessful exit. Now, we all know life can be unpredictable, and there's pretty much nothing you can do to stop it. The only thing you can do is really prepare for it as best you can. And that is why having an exit strategy is so important, as it prepares you and the business for those eventualities. Now, I believe every business needs to be exit ready as soon as possible for 2 reasons. Now, first of all, should life throw a curveball, you can respond in a very controlled manner. And second of all, the owner gets to reap the rewards of having a business running as efficiently as possible. And being prepared gives them the very best chance of exiting the business successfully. Now, these figures are pretty interesting. The stats are from 2019, and they may have changed slightly due to the pandemic, but it does give you a very good idea of how much the SME market dominates the UK business landscape. There are around 1.4 million businesses employing more than one person. And then companies that are employing 1 to 50 employees account for around 97% of the UK market. So given the sheer number of companies and the fact that the baby boom generation will be retiring the next 5 to 15 years, it will make it a buyer's market, and it will make a huge challenge for owners to stand out from the crowd and to attract the right buyers and the right investors. Now, out of the 1.3 million companies, more than 90% are not sellable in their current condition. It is estimated that there's around 4% for sale, whether they are for sale privately or through a third party, and that makes around 50,000 companies. And out of those 50,000 companies, less than 20% will sell for what, less than 20% will actually sell, or less than 10,000 companies will sell. And furthermore, out of the 10,000 companies, less than 5% will sell for what the owner expected to sell for. Now, I'll just share with you some of the problems and challenges that I come across all the time, as it's these challenges that are causing most deals to collapse and causing the market to stagnate. The first is time. And a common trend I see is that owners plan their exits far too late. Many people don't realize that it ideally takes up to 5 years to prepare and sell a business. And I was asked this last week, why 5 years? And I say 5 years for 2 reasons. Firstly, it'll be less intense and it will give the owner time and space to consider options and make decisions and implement measures effectively, especially when it comes to the due diligence phase. And secondly, depending on where the business is, it could take up to 12 to 36 months to get the business ready. Really, sometimes it won't take 5 years in most cases. However, from a buyer's perspective, they want to see positive, sustainable trends because that will add confidence and value to the business. What you don't want to see as a buyer is a massive spike in sales or profit just before the business goes on the market. And very often, I come across these spikes where the owner has conducted a huge marketing exercise just before they go to sale and bring the business on the market. And I'd see the turnover jump by 25%, and the seller then uses that increase in turnover or profit to justify their valuation. But no one knows if that growth is sustainable or not. And to be fair, buyers see right through that. So time allows the buyer to see what's really happening in the business and what's actually achievable. Next is valuation. And this is the biggest reason why deals collapse. This is an incredibly emotive subject. And the last thing you want is for a buyer and seller to try and convince each other that they are correct, because it rarely leads to a successful conclusion. If you were to ask 100 people to value a business, you could probably get 100 different answers. So the key here is to focus on the facts. The next is risk. It is a lot easier and less risky to buy a business with a turnover of £3 to £5 million rather than a business with a turnover of £500,000. Larger companies have the ability and resources to weather the storms, whereas smaller companies are somewhat limited. So as owners, we need to look at how to reduce those risks as much as possible. Next is transferable value. And transferable value is what a business is worth to a buyer without its previous owner, and is determined by how well the business runs without that owner. And transferable value should not be confused with profit. And I've got a client who's a classic example of this. He's looking to sell his business in the next 3 years for about £1 million. Now, the figures, the finances all stack up. However, because the business is so reliant upon him, upon his experience, his expertise, there's very little transferable value that can be given to a new owner. So when he leaves, the business leaves with him. Next is deal structure. And this is the second biggest reason why deals collapse. A lot of owners believe that there's only one way to structure a deal, and that's to receive a huge check on completion. Now, That may happen, and it certainly does happen, especially when it comes to large corporates. But for most SMEs, it's rare for this to happen. And knowing that there are various ways of structuring an acquisition will help feed into the exit strategy and give the owner as many options as possible. And lastly, business brokers. Now, I don't mean to tar everyone with the same brush, but there may be some very good brokers out there, but the ones I've come across are really underserving the market and causing it to stagnate. They don't value companies correctly, and their main aim is to sign up as many companies as possible and charge them anything between £3,000 and £40,000 just to market their business. If they sell, that's a bonus, but their main aim is to sign up as many people as possible. And it's this behavior that I deem toxic, bad for the industry, and it does need to be addressed. Now, I've looked at several hundred companies and have found there to be two areas that need to be addressed. The first is we need to prepare the business for sale. And secondly, also we need to prepare the owner for sale. And this exit roadmap is something that I developed and tested out in my previous business. It is a holistic approach that uses a roadmap that undertakes a personal and business wrap. And that is to review, analyze, and prepare both the business and its owner for the exit process. The personal wrap looks at the owner and determines the timescales, the future requirements to find the best type of exit strategy, and one that will meet those needs. We then look at getting all the partners and shareholders aligned and address any personal tax and personal risk elements. Now, these elements are then reviewed every 6 to 12 months and fed back into the business growth strategy. We then turn our attention to preparing the owner for what happens post-sale. And we look at the 5 Fs, and that's family, friends, faith, fitness, and finance, and combine that with any future life plans. And this is key because it helps with the emotional and identity attachment to the business. And by addressing this will allow the owner to be as neutral as possible during the sales and negotiation process. We then also look at what might happen in the future for any unexpected events such as the 5 Ds. And that's death, disability, disease, divorce, and disagreements to either the owner, their partners, or their loved ones. And we'll put in place the various processes that will help the owner and their business cope with any such events. Now, once we've addressed the owner, we then turn our attention to the business, and we will determine where the business is at present, including its current value. And once that information has been gathered and taken the goals set during the personal wrap, we then are able to formulate a route or a set of action plans to achieve those targets. And this too will be reviewed every 6 to 12 months in conjunction with the personal wrap to ensure that the business is still on track and to make any course corrections where necessary. And lastly, the roadmap looks at preparing for the sales process itself in terms of getting all the documentation ready and completed in preparation for the due diligence phase. Now, this phase can be incredibly time consuming, and getting it as much of it done beforehand will save a lot of stress, not to mention cost. But there's also another advantage. Being prepared for this phase and having all the documentation ready sends a very clear message to the buyer that A, you are serious about selling, and B, your business affairs are in order. And that will give a lot of confidence to any buyer, not to mention allowing the seller to stand out from the crowd. So by looking at the entire picture of where the owner and the business is now and where they want to be in the future, we can then put the necessary measures in place to give them the most options. And should the unforeseen events happen, everything will be in place to make the exit as smooth as possible. So a bit of a key takeaway from this presentation is that sellers tend to focus on price and buyers tend to focus on value. So to make a business sellable, the seller needs to think like a buyer. So now we are going to look at the EVA report. I've left this as much time as possible because I appreciate that this report is somewhat detailed and there'll be a lot of information thrown at you. So I'll just swap screens quickly. Right, can you all see this screen now? Excellent. Well, there we go. Right, now what this report does, it takes all the financial information within the accounting system and it displays it in such a way that enables the buyer to make a purchasing decision and also forms the basis on which they can value a business. And from the owner's perspective, this is how a potential buyer will look at their business. So by having this information before the owner is needing to sell, will allow them to get their business affairs in order and to start planning and preparing for sometimes those rather difficult questions. So we start off with the contents page. And we look at the first section, we look at what's gone on in the last 5 years, the average performance and the movement over the 5-year period. And then the appendices, we'll look at the last 12 months in depth. So we start off with the rather large, big picture overview of the business, and then we'll go into the detail of the business and what's really happened in the recent past. So first we are presented with a high-level overview of the business over the past 5 years. And this is really to get a feel for what the business is doing on average. And from a buyer's perspective, they'll be looking for trends. Let me just go in here. Can you all see that clearly now? Is that better? Okay. So if we look at revenue, for example, is it trending up or is it trending down? And in this example, we can see the revenues are slightly trending down. But the gross margin is pretty much flat. And because the revenues are trending down slightly, this is causing the gross margin rate to actually increase. The overheads are slightly increasing, which will have an impact on net profits. But as you can see, net profit has remained pretty much the same where we are this year compared to 5 years ago. We then have an indication of the net worth, the cash balance, which you can see is negative for the last 4 years, as well as the cash ratio, the accounts receivables, and the accounts payable. So this really gives you a good overview of the business and how it's performed over the last 5 years. And now what we're going to do is we're going to take each section and look at it in more detail. So here we have the revenue analysis. And what we want to do here, the idea behind this page is really to give you an idea of what's happened in the last 5 years, what's happened in the recent short term, and what is probably due to happen going forward. So let's zoom in. So first of all, these are the bars that show the turnover of the last 5 years. And then on the right, we have the explanation of what's really going on and gives a bit more context. And you can see that this business has a compound growth of negative 2.9% over the last 5 years. Then there's also the seasonality of the business. And from a buyer's perspective, this is really important because it determines what I would need to do depending on when I buy the business. And looking at the last 5 years, I can see there's as much as a 32% variance between the highest and lowest month. So when acquiring a business, it's good to know what to expect in the first 3 to 6 months in terms of working capital or any extra staff required for busy periods, information like that. Then we see the turnover by month for the last 5 years with a rolling 12-month average. And then we analyze the performance per quarter. We look at each quarter over the last 5 years relative to the date you selected for your reporting month. And this allows you to give the buyer the very latest financial information, irrespective of when the year end is. One of my many frustrations is when I ask a seller for financial information. They give me their year-end accounts, which at the time we may be 9 months into the current financial year. And then I'll have to wait for updated information to be sent. But this report gives the current up-to-date information straight away. What we're then doing is comparing the most recent quarter for what happened in the previous years. And you can see that the last quarter in December to February is the worst quarter this company's had. And to be fair, not much has changed for March to May. You can see that the revenues are actually being held up by these 2 quarters. Now we'll be able to look at this in more detail later on, so we can find out why this is actually happening. So we take all this information into account and carry out an approximate projection. Now this is not a forecast, but this is exactly what a buyer would do when looking at these numbers. Now there are 3 projections that we will use. The first revenue is first we take is the revenue of the last 3 months. And if I were to apply this trend, what will my revenues look like going forward? As you can see here, it's a pretty sharp increase. We do the same for the last 6 months and the last 12 months, and this is the results we get. So all we are doing here is looking at what happens in this business. If we look at the explanation above here, we can see that if we take the last 3 months, the trend, we will then increase the revenues by 7% year on year. However, if we take the last 6 months, there will be a reduction of 3.8% and a reduction of 0.2% for the last 12 months. Would anyone like just to have a look at this page again, just to get the bearings? Or we'll just carry on. We then look at customers, and there's a more detailed analysis that you will see later on. But this page is really, all we're really interested in this page is the customer trend and the customer risk. So first up, the revenue has been made up of 175 customers, out of which 79 are new customers. And when we say new, those are the customers that did not transact with the business in the previous 12 months. Now, you may have a business whose selling cycle is 2, 3, or 5 years, in which case this statement doesn't really hold much water or isn't really relevant, because I'm only comparing 1 year to the other. But for the majority of businesses, you would expect to see recurring revenue from a customer at least every year. We then look at how many existing customers made up the 175. And we can see that 96 customers were retained from the previous year. However, 92 were lost. But the owner replaced those 92 with 79 new customers. So from a numbers perspective, the business is losing customers and not gaining. And then we look at the risk associated with the customer base. So for customers this year, it's made up of the top 5%, the top 10%, and the rest. And here we can see that 57% of the sales in the last 12 months have come from the top 10 customers, which is an increase from 50.7%. Now, the number is going to be relative to the business, relative to the sector, so we don't comment on the actual number. But what we can say is that the risk relating to customers is increasing because the top 10 customers are now responsible for more revenue than they were the previous year. But this may be perfectly acceptable at this level, but it does give an overview from a customer risk and a customer acquisition, customer retention perspective. We then look at accounts receivable. Now, why is accounts receivable important to a buyer? Because really the theory is that it has very little bearing on valuation. However, the buyer will be inheriting those customers who are expecting to pay invoices within, in this case, 80 days. And they'll probably want to and still expect to pay those invoices in 80 days. So I won't just simply start paying invoices in 30, 35 days, although this could happen over a gradual period. So the buyer will need to factor the sufficient cash flow to budget and to bridge the cash gap. And in this graph, we can see the seasonality of the accounts receivables. Because as a buyer, I could take on this business at a certain point in time and need to understand how quickly those receivables are going to change. So this shows me the cash flow movement in the business. So here we have margin, and here we have cash margin in the bars, and the gross and the margin rate in the triangles. So cash on the left, cash margin, and the margin rate on the right. The explanation is simply states that the gross margin movement of the business of the past 12 months has increased by 1%. And if I were buying this business, I would probably explore what was driving that increase. We then look at the average, what the average was over the last 5 years with the highs and lows. And we then map that out over the last 5 years with the gross margin rate and a rolling 12-month average. So you can see that from about September 17, that the margin has gradually increased. Then we look at how the quarterly margin rate has performed over the last 5 years. And on the left, we have a table to show how the business has performed this quarter versus the quarter in the previous year. Then we look at the gross margin projection, and we take the margin achieved over the last 12 months, last 2 years, and 3 years, by applying the average margin rate for those periods and projecting those rates over the next 3 years based upon the 6-month revenue rates we used earlier, which then gives a slight decline in the gross margin. Then we look at overheads and to complete the P&L, and we can see the overheads expenditure both as a monetary form as well as a percentage of revenues. Some of the costs, some of costs are fixed and some are variable, but we do need to take into account the overall cost of the business in relation to the revenue it generates. We make a similar comparison to expenditure over the last 12 months, as well as over the last 5 years, as well as the highs and lows. We then trend this out over the last 5 years so you can get a good understanding of the trading performance of the business at a high level. We then look at the individual quarters over each of the 5 years, and the grid on the left is comparing the most recent quarter to the same quarter in the previous year. Now, to come up with a high-level view of profit, we need to project the expenses forward, and we take the average overhead expenditure for the last 3 months, 6 months, and 12 months. And again, this is just an indication. Now we just need to do the same for net profit, which is pretty much in the same way as you've seen before. There's an average net profit of £62,000 and a high of 83k and a low of 43k. We then plot the net profit over the last 5 years with a rolling 12-month average. We then compare the profit per quarter to the same quarter in the previous years. We can then carry out the profit projection. And this is typically what a buyer would do when they look at trends. And they will take the trends, normally the worst case scenario, and project those forwards. So take the monthly overheads over the last 3, 6, and 12 months and apply a 2-year gross margin average. And that then looks, and this is what it looks like. Now, this business could be in a cycle and is about to start the next downward curve. So as the seller, they will need to be aware of this and also be able to ensure they can explain this to a buyer. So that is the P&L part. We looked at all the bits in the first slide I showed you, and we've then looked at them in a bit more detail. So now it's down to looking at the balance sheet. So we need to look at the fixed assets, the fixed asset base. And at this stage, I'm not really interested in the value of the assets. What I'm more interested in is the movement of that fixed asset number. And this graph is telling me that no investment has taken place over the last 5 years because the fixed asset value has just gone down. This may or may not be a good thing, but it's a question that needs to be asked and the seller will need to be prepared for it. So here you can see we have gone from 150k to 75k, and we get there by breaking down the following areas. This is where we were 5 years ago. This is the movement of the tangible assets, the movement of the intangible goodwill, and the depreciation. And you can see that the majority of the movement is through depreciation. And that says that no investment has been happening in the business. So from a buyer's perspective, will these assets need to be replaced? because it could just be another cost that a buyer would be liable for in the very near future. We don't know for sure, but that is something to consider. We then break the fixed assets down and we'll show them what happens over the last what's been happening in the last 5 years. And then moving down the balance sheet, we look at the current assets and the current liabilities. So what the question we really need to ask is, what are the current assets, what the current assets look like, and how they've moved over the last 5 years. And you can see with this business, it's been quite variable, but the maximum variation has been plus 30K and minus 20K. The graph below shows the reason for this movement. We have current assets at the top and current liabilities at the bottom. And here we try to show you why this movement has happened. And here we are at 0 because the current assets are equal to the current liabilities. There are points where the net current assets are above and below the line, but we are trying to give you the understanding of how they move. We then move to accounts payable, where we can see the number, but also get an understanding of what the supplier's expectations are. You cannot go into this business with expecting to pay suppliers in 45 or 60 days when they are expected to be paid every 24 days. So this is really about understanding that expectation. Now, some of you may have noticed that in this company, the debtor days are 80 and the creditor days are 24, which is not great because it leaves a pretty huge cash gap and something that a potential buyer will definitely pick up on. And now you can see why the cash balance is always in the negative. So it's about bringing all this information together so we don't just get an understanding of the performance of the business, but we also get the working behind the performance of the business, because this is the reality that a buyer will face when they take over the business. We then go to the cash flow of the business, how that's been performing, as well as the stock of the business. As you can see, that the stock has been pretty static over the past 5 years. That's around 8 days. But what is interesting is that the stock doesn't vary that much, but there's up to about a 32% variance in revenue. And again, this is something that a buyer will pick up on and a seller will need to be able to answer. And there may be a very good reason for it, but being prepared is the key for the seller. Then we will go into detail about what's going on behind the current assets and current liabilities of the business and how they've moved over the past 5 years and the reason for that movement. We also look at the long-term liabilities. Now, we've not covered this at the moment, but from a buyer's perspective, this is either going to be a sale where they're taking everything on in the balance sheet, or to be on a debt-free, cash-free basis. But the buyer will need to understand what's in that business before going ahead. Then we look at the custom analysis in a bit more detail. And here we've got the list of the top 5 customers. Now we know the top 10 customers are accounting for 57% of the total revenue. So here we have the most valued customers in relation to revenue. And for customer 772, they've accounted for 22% of revenue. Customer 372 has accounted for 4.5%. And here we have a customer who's in the top 5 because of their spend 2 or 3 years ago, but the last 12 months haven't done really much. And here's a new customer and their revenue contribution is increasing. Then we go to the supply analysis and we look at where the money's going. And this is really down to understanding risk within the business. And for instance, here we have over 30% of the spend going to one supplier. Now, this may be perfectly legitimate and reasonable for this business because there may be not many suppliers for this particular company. But from a buyer's perspective, they want to know what alternatives they are should anything happen to that supplier. And here we can see which sales channels are contributing the most to the revenues. And here you can see sales channel 4 is contributing 69% to the total revenues. Now, it's important to know that these nominals need to be coded correctly. And if I code everything to one nominal, all I will have is one sales channel. That's just worth bearing in mind. So this gives you an overview of the business over the last 5 years. So going forward now, we are going to be looking at the last 12 months of the business and comparing that to the previous 12 months, and to give you a good understanding of what's happened in the business in the most recent period. But to start off with, there are just some ticks and crosses to show you what has worked well within the business and what hasn't worked well in the business. So from a buyer's perspective, this is really a conversation starter where they can ask the seller, why are these things moving in the right direction? And why are these things moving in the wrong direction? Then we look at the business in a lot more detail. Just zoom out. There you go. The first thing we want to do is look at profit and the drivers of that profit over the last 12 months. So we can see the profit has increased by 20,000, which we saw in the annual graphs. But now we want to know the reasons for that movement. And on the right-hand side, we have the profit impact. So here we have revenues that have moved by -2,000, and it's pretty much had very little impact on the profits. So the revenues have moved by -2,000 £, and we can look at that, break it down in transactions and average spend. So the transactions have increased by 5%, which have contributed an increase of £50,000 revenues, but the average spend has decreased by 5% and has a negative impact of -52k on revenues. Therefore, the only reason revenues have remained pretty much the same is because that the average transaction value has been reduced. So the big question for this is, or from the buyer's perspective, is why has that happened? Then you can see from the profit has moved by 1% using the gross margin, and this has added a further 10k to the bottom line. And we also had a decrease in overheads of 10k, and that's added again 10k to the bottom line. So the reason for the profit movements is down to cost reduction and not a growth in revenues. And then we go to this graph at the bottom, and it really shows you the key drivers and how they have moved year on year. And then we look at the revenue analysis. We then look at the detail of the revenue trends, the transaction trends, and the average spend trends. And it's purely focusing on the last 2 years. And we talked about the reasons for the movement and the impact it has on revenue. So here we have a -2k movement. And we know that the transactions were responsible for a £50,000 movement, as well as the average spend has an impact of -52k. And if we want to, we can go into the various quarters to see what impact that movement has. In the customer analysis, a bit more detail here. We look at the top 10 customers, as well as the customers who have spent the least with us this year compared to last year. So a typical question that I would ask a seller to explain is that almost £240,000 in revenue was lost last year. And for a company that with a £1 million turnover, that's around 24% of lost revenues. And this will be a very good time for us to know the answer to that question before it gets asked. This is the various revenue channels. And we go into the channels a bit more detail per month, per quarter, and the last 12 months, and look at trends of the top 8 channels. In the margin analysis, we look at margin analysis in pretty much the same way. We've got the graphs with showing the margin on the month on a monthly basis and the rolling 12-month of the averages of that. And we've got the table on the right with the quarterly movements. We've got the cost of sales, and we're looking at what is causing cost of sale movements and which cost of sales are performing well and which are not. And we can use the red and green flags to make them easy to see. And again, a potential question from a buyer would be to a seller, could you please explain why cost of sales 5 has increased by 1% when the rest have pretty much have decreased? And then we look at overheads, and pretty much in the same way, and we pull together all of that and look at the profitability to finish off with the path that leads to where we were to where we are now. And then we look at the balance sheet. And again, this is again a pretty much a high level view over here, but we then bring in a few more ratios such as net worth, current ratio, cash ratio, and debt to equity ratio. We then compare the key lines of the balance sheet in relation to this year compared to last year, and we look at the debtor and creditor days. We then look at in detail at each of the current assets and current liabilities this year compared to last year. Now, previously we looked at the movement over a 5-year period. Now there's a bit more detail over the last 12 months compared to the previous 12 months. So there you have it. I've tried to go through as quickly as possible due to time, but it's about a 23, 24 page report, which gives information designed to educate a seller and to give a buyer the understanding of what is going on inside the business. Do you have any questions?
One for you there, Cliff. Can you hear me all right?
If a company has changed software in the last 5 years, obviously you've got an issue there. Is there a way of importing that in some other means?
It's probably a more question for Mike in terms of the technical accounting stuff, I think.
Yeah, the answer is there's always a means, Brian. So it's just a question of as long as stuff can be taken into a CSV file, which most software can, then we can then import it to be analysed. It takes a bit more time. So where we're working with cloud accounting, mainly in Xero, QuickBooks Online, and Sage, that does it. But where people are have got this information, but it's available and it's in a different format. We have to then export that information by CSV file and then re-swallow it in. I mean, the point that when I looked at that is, that gives a whole load of information, but it's the questions that Cliff was asking. So as a buyer, if you have to think like a buyer, and then you prepare yourself for the questions, because if, for example, like the dip there, are we going down into a downward dip into our sales because we got a lot of seasonality and trends, then we're going to have an answer as to what we're actually planning to prevent it. So when Cliff was introducing and saying, look, this can take 5 years, and there's a good reason why, because you can't just have it in theory, say this is what we're planning to do, and this is what we're going to, and this is what we've done in the past. We've proved effective, and so they've got to test it. But the more prepared you are, the more likely they are to believe in the business.
I have a question for you, Cliff.
Yes, Andy.
We got echoes going on.
I have a question, if I may.
Yeah, go for it.
What stage of the process should the due diligence information be made available? There's obviously a lot of detailed information there that would be very interesting to a competitor. Have you got any thoughts on that? And also, the current situation with the coronavirus has obviously thrown a lot of businesses into a bit of a turmoil. And if buyers are looking for trends, what impact do you think that will have on the market?
That's a very good question. In terms of the due diligence, I would say I would tend to work on the DD stuff as soon as possible, and I would tend to create what I call a seller's pack, which has all the legal and financial information to it. And I'll update that every 12 months or every 6 months, depending on what I need to do. And then I'll keep that updated. And when I need to present it to a buyer, I would do so. But I'll ensure that if you appoint a broker, they tend to send this information out once the buyer has signed an NDA. What I'm looking to do is create a locker room where people can only view this information and they can't download it or use it. In terms of the other question about coronavirus and trends, that's interesting, because the new metric that I feel is going to come from valuing a business is how quickly the company bounces back from how quickly the business bounces back from the coronavirus. So effectively, there'll be a metric that of measuring how quickly the company can return back to pre-COVID trading. And if it's a long, drawn-out process, that could impact valuation from a transferable value perspective. But I'm dealing with a seller now who is valuing his company pre-COVID, and we're about to do a deal where I'm happy to value the business pre-COVID, not that current valuation where the company is right now, but there'll be a really large deferred element of payment that will only start once we hit pre-COVID trading. So if it takes 12 months, that's when the deferred will kick in. If it takes 2 years, that's when the deferred will kick in. So there's a bit of a buffer for both the buyer and seller. I hope that answers your question.
Yeah, no, that's really, really useful. I mean, I've got some more questions, but I don't want to hog the floor. So let the other people jump in.
I just have one question, Cliff.
Yep.
A growing portion of my business is based on coming on internet sales. So that's going to be upping my customer base, and a lot of them aren't repeating. Will that negatively affect the value in your report?
I think if you can show a trend that whether those customers are repeating or not, when the ones that aren't repeating, are you filling up the pipeline with new customers? So as long as you have a trend of growth, or at least a static trend year on year, that should be fine. But as soon as you have a big increase in customers and then a slow trickle off, and that's something to be concerned about. But as long as you can prove that the marketing cycle is replenishing those customers that you lose year on year, that should be fine.
So you would in that report group your whole internet sales sort of as one entity, as one customer, more than sort of individuals perhaps, or would you see them dropping off, one dropping off, two coming on?
I would probably, again, this is a chat with Mike, because potentially that could be worth doing as one nominal, but typically what they're ordering, and if you want to split those up. So there's probably a discussion that we can work out, what is best going forward, but yeah, potentially be under one nominal.
Okay, thank you.
Cliff, if I could ask my other questions, that'd be great. Hopefully they're of general interest. Around 60% of our revenues are recurring revenues due to software licenses, internet subscriptions, those sort of things. How would they appear in the report? And also, kind of related to that, is IPR. How would that appear in the report, and who would be responsible for valuing it? And I guess it would be of interest to a buyer, but I'm not quite sure how they might take that into consideration.
I think it's probably with Mike as well, looking at how best to lay out your accounts. I'm not too sure what the best, I don't know your business at all, so I can't kind of say which is the best option, but I think that's a discussion with the accountant to work out what is the best way of setting out your nominals.
Okay, and a very quick question. Interesting what you were saying about debtor days and creditor days, and maybe we're being a little bit naive, but we try pay our suppliers as quickly as possible. But from what you're saying, that's not a good idea. It's better to delay them to get them in line with our with our debtors. So
that doesn't apply to our bills, Mike. I just need to emphasise.
Oh yeah, you're on a direct debit, aren't you, Kevin? You just suck it out when you want.
That's a very good question, and I'm a firm believer in protecting cash flow. So there's a bit of a balance to be struck here. You don't want to start paying suppliers late and ruining that relationship, because that just doesn't work for you. So it's really looking and using the supply terms. Now, what I tend to do is negotiate with suppliers. If they can't give me some discount on my spend with them, I look at pushing my payment days out as far as possible. So what I'm trying to do at the whole time is to keep as much money in my account as possible before it goes out. So if I can have my debtor days shorter than my creditor days, then I don't have a cash gap. I've got a cash buffer. So the whole idea is to really try and bridge the gap between creditor days and debtor days as much as possible. And ideally, if you can go over, that's brilliant. But if you can just make them the same, it's great, but obviously don't upset the supplier relationship.
Okay, no, that's great. No, thank you. I'll bear that in mind.
The only thing I'd add to that, Mike, on the valuation on IPR, it's like a dark science valuations, as Cliff said earlier. And so, depending on how you value goodwill, sometimes it's a mixture of future profits plus the asset value. So depending on the value of the IPR, so goodwill is defined simply as the number of years of future profits you're prepared to pay for before those profits become yours. You then, if you actually got an asset that's a value in its own right, sometimes you'd have to do a mixture. So there's no sort of standard answer on that, but yes, it would have to be taken into account and a view would have to be expressed.
Yeah. Okay. Thank you. Sounds as though we need to talk.
Any sort of thoughts from people about that? I mean, it's a pretty comprehensive due diligence pack, but I think the figures are just figures. I think it's almost like pre-arming yourselves with information to anticipate. I find that when people are putting their businesses up for sale, it becomes a bit of a game, and too much these days, because the brokers, and again, one shouldn't generalize, what they're interested in is just getting their sale. And so they'll put the price, whatever price you want, but they probably don't believe they're ever going to get that price. And because all they're interested in is they will get a commission come what may. And so they'll just want to get the quickest sale, and then on to the next poor guy or lady that they can con into doing the price. So the whole issue is it's got to be planned and say, what do you think you're worth? And what do you have to do to be worth it? So, these brokers, I mean, I've dealt with one recently, and they haven't got a clue how to, they'd come up at a value, and I just said, well, how did they arrive at that value? Oh, there's the trade sale. I said, that's ridiculous. There has to be some sort of justification to it. And the client ended up selling because he'd sold in his head. And so he sold at far too low a value. And the broker didn't mind because they got their commission. And that's the danger in terms of preparing these things. So, you can still do a quick sell. I've just had a client who sold 40% of his business for an awful lot of money, despite all the uncertainty, and so still retain control. So he's in there for the long game, but what he's got is investors who've injected the capital into his business that allows him now to go for the big ticket prize, but he's taken out lending by an injection of capital. But because he's still got control, he's not going to be dictated to by the venture capitalists, so that he's still able to get his own team working in the way with his own values. And so is anything possible as long as the business is attractive enough, but there's an awful lot of work went in to make it attractive to the buyer. He would have killed to have had this detail made available.
And would that work, Mike? Say, for example, you had three shareholders, and two of those shareholders had a majority stake, and the third shareholder had a large minority stake, and they wanted to exit the business.
Yeah. Anything's possible. It's just the parameters. Anybody who's prepared to invest, they would need some sort of shareholder protection to protect their rights, because if they are a minority, then there's a limit to what they will allow people to do without their say so.
Yeah. Okay. Interesting. Thank you.
It has to be a significant minority, I think, though.
Yeah, about 45%.
Yeah, very much so. Then very possible.
Yeah.
I think with exit planning and getting your business ready, it's being prepared, both the business from a business point of view as well as your own personal life, and understanding what you need to exit and what you want to exit, and getting as much information about your business as possible, because at the end of the day, a buyer will dissect your business, and if you know more about your business than the buyer, you're one step ahead. But more often than not, the buyer is always a step ahead of the seller. And this report allows you to get one step ahead of the game.
Yeah, and you're absolutely right. And I think for most businesses, and certainly it would be for ours, we would be actually selling to, say, a technical department within a larger company, but the actual people who are doing the analysis aren't the people that we would normally deal with. the mergers and acquisitions people, and they would be more interested in figures and metrics that are more alien to us, if you like. So I think it's a really good idea. I like your idea of having getting a seller's pack together at the earliest possible moment, including all of this information, and then just keeping it up to date, because then you are aware of the sorts of questions that could be asked, and being prepared is forewarned. So I think that's really, really good advice. Makes a lot of sense to me.
That's one of the tactics is used in acquisitions, is that the buyer will go to the seller or the solicitor or the accountant and go ask the seller, can I have this piece of information, please? And they get the piece of information. It could take them 2 days. Then 2 days later, they ask another question. And then wait, another question. And eventually you tire the poor seller out to the point where he goes, I don't care, just go away. Yes, don't want the business anymore. So it's a tactic that is used. And if you can avoid that by just saying, there's a full pack for you, you probably won't need to ask me any questions because I've covered everything for you. That just allows you to continue working in the business and making sure that the revenues and the profits remain, because that's another metric we look at during the DD phase. And you can then exit properly from the business without being completely swamped with questions every 5 seconds.
Yeah, I mean, this might be a question for Mike. I mean, would you advise that the seller's pack is created by a different organization that you're using as a broker? Because a lot of the brokers actually offer to do that for you, and I'm just wondering whether it might be better to separate those two things, especially if you're going to be doing it in advance. I guess it would make you'd have to do it then.
Yeah, I think it depends who the brokers are, because you get some and some, but yeah, in the end, they're not, all they're interested in is how do they get paid. Yeah. So they might talk a good game and say, oh, we're really interested to maximize, but they're not. They're just interested in getting the best pay ticket they can get. And so they're not interested in the detail. They want to make it look pretty, because the prettier it looks, the more they can charge for it. So I see all sorts of sales packs that have got full of arty-farty designs that are totally irrelevant, but it makes them look good, and it adds an extra $5,000 to the fee, because they've done it. So it's highly professional. This is what people expect. It's rubbish. Any buyer wants to actually get underneath the bonnet of the business and see what's actually going there. So all those questions that Cliff was asking, the next step would be right, how do we prepare for that? So if we've got certain gaps, so we've got certain customers where we've got new customers, certain customers where it's dropping off, what gaps are there? What can we do? Can we now sort of anticipate some questions? Can we actually go behind the scenes again and say, are there some windows of opportunity where, for example, compared to the nominal stream, if everything goes to one nominal code of sales, then we're missing a trick. So this is where the analysis has got to be done correctly. So it's got to be broken down by revenue streams, because we need to look at the sales mix where we might have high margin, low volume, but equally we might have low margin, high volume, and we need to know where the trends are for those, because that's really what's relevant. The amount of stock that is held by for those income streams. Are we holding a heck of a lot of stock for low margin, high volume? It's very relevant, because it means the risk attached to those low margin, high volumes is far higher than if we're holding lower stock, but for lower volume sales, but very high margin sales. So there's all sorts of different questions that get asked. And if we're sitting there preparing, and this is where Cliff, with his advisor hat on, comes into his own, because he comes in and looks at it and says, if I was buying this, these are the questions I'm going to ask. So this is how we use Cliff to help prepare in a consultancy capacity, to actually look at the figures and say, what would I go in there and ask that? And so in terms of developing this due diligence report, there's all sorts of other reports that sit alongside that can be added as a part of the so what test. So that's that's the it just allows you to be prepared, as it were.
Yeah, makes sense.
So the report that we just gone through is a dream report for me. If every seller can give me that report, it will make my life very, very happy, and will save me a lot of time having to dissect information that I get given. And to be fair, the information that I do get given is pretty low class. So by giving me a decent, detailed 24, 25 page report of what your company looks like would have saved me tons and tons of time. And as more and more companies come on for sale, investors and buyers will look at companies that are prepared. They don't have time to waste looking through the dross. If you can give a buyer that information, they'll love you. And you immediately stand out from the crowd.
Yeah, you're on the front foot.
Yeah.
Excellent.
Anybody else got any questions?
I've got to go because I've got another meeting. So thank you very much, Mike. And thank you very much, Cliff. This is the first one of these I've attended, and it's been really useful. Thank you.
Excellent. Well, nice to see you and glad it's been of use.
Take care.
Okay. Anybody else? Any questions? Conscious of your time and the next meeting to go to? Okay. Well, Cliff, really good. So this is the when you presented for us before you'd actually done all this amazing work in terms of helping generate this report. We talked about preparing and the importance of cash flow, how many businesses you see are basket cases, and so you identify how bad they are, and so that as a buyer, how you can just negotiate because you realize how desperate they are. So that's almost like another angle, a tactic, how to buy a business, to how to go. There's another area we can be looking at, and I think it'd be worth us doing a session on that. But because again, putting ourselves in that position, if we were the acquisitive one, how do we buy a business effectively to grow our business? We can then reverse our hat and say, gosh, if somebody was looking at us and thinking the same way, how do we prevent that happening? So I think there's sort of various ways of skinning the cat on that. So Cliff, thank you very much indeed. If anybody wanted a copy of those 10 or 12, I can't remember, sorry, I put it on the flyer, but is that available? Should anybody want one?
Yeah, I can email the report to you, Mike, and you can send it to them if you like, or it's on my website at businessoptics.co.uk and it's free to download.
Brilliant. So I'll follow up to everybody who's attended and just say, if you want a copy of that leaflet, the booklet, sorry, then Cliff will send it to you. Alternatively, let me know and I'll send it to you as well. So thank you for everybody attending and hope it's of use. Any questions that you have as a result of that, do let us know. And obviously, if you want to talk about what a good session it was and want to go on Google reviews, I won't object to it. So any marketing is good marketing. Thank you very much indeed. Okay, bye for now.
Thank you.
Thanks, Mike. Thanks, Cliff.
Thank you.
Bye.
Goodbye.